Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of exploring the basics and future of derivatives markets in 2024. Ever wonder how financial markets manage uncertainty? Enter the world of derivatives markets. These financial instruments are key players in today's global economy. They help businesses manage risks tied to assets like stocks, bonds, and commodities. By providing tools for hedging and speculation, derivatives create a buffer against market volatility. But what exactly are they, and how do they work? This video will break down their basic concepts, showing why they're essential for economic stability. So if you're curious about how derivatives shape financial decisions, keep reading. Understanding derivatives. Derivatives are financial contracts that derive their value from an underlying asset. They serve various purposes, primarily to hedge risk or speculate on future price movements. Imagine you're planning a trip, and you're worried about currency fluctuations affecting your budget. In this case, you might use a derivative to lock in a specific exchange rate, ensuring you don't lose out if the value changes unfavorably. Let's break down the key components of derivatives. What are derivatives? At their core, derivatives are agreements between two parties to exchange financial benefits based on the performance of an asset. This asset can be stocks, bonds, currencies, or commodities. For example, consider a farmer worried about falling wheat prices. He could enter a contract to sell his wheat at a set price in the future, protecting himself against potential losses. Some standard examples include futures contracts, agreeing to buy or sell an asset at a predetermined price at a future date. Options contracts, giving the buyer the right, but not the obligation, to buy or sell an asset at a specified price within a set time frame. Swaps, exchanging cash flows or other financial instruments between parties to manage debt or interest rates. Types of derivatives. Understanding the different types of derivatives can enhance your grasp of financial strategies. Here are the main categories. Forwards, customized contracts between two parties to buy or sell an asset at a specific future date for a price agreed upon today. These are typically traded over the counter, OTC, not on exchanges. Futures, similar to forwards but standardized and traded on exchanges. They cover a wide range of assets, from commodities to financial instruments. Options. These provide the buyer the right to buy or sell an asset at a set price before a specified date. Options can be categorized as either call options, buy, or put options, sell. Swaps. These involve exchanging cash flows between parties. Common types include interest rate swaps and currency swaps, often used to manage interest rate exposure or currency risk. Key characteristics of derivatives. Derivatives have unique features that differentiate them from other financial instruments. Here are a few key characteristics. Leverage. Derivatives allow investors to control a larger position with a smaller amount of capital. This can lead to higher profits, but also increases risk. Hedging. They enable individuals and businesses to protect against losses. For instance, an airline might use fuel hedging contracts to lock in fuel prices, securing their operating budget against price spikes. Market speculation. Investors often use derivatives to speculate on price changes, aiming for profit based on market movements. This adds liquidity to markets but can also introduce volatility. Complexity. While derivatives can be powerful tools, they can also be intricate and challenging to understand. Their value often changes in relation to multiple variables, making them suitable for experienced investors. These characteristics demonstrate why derivatives are a crucial part of financial markets, serving both as risk management tools and as instruments for speculation. Whether you are a business protecting your interests or an investor aiming to profit, understanding derivatives is essential. What aspects of derivatives intrigue you the most? Functions of derivatives markets. Derivatives markets play a vital role in financial systems by providing tools that help manage risk and create opportunities for profit. These markets allow participants to hedge against uncertainties, speculate on future prices, and contribute to price discovery. Let's explore these functions in detail. Risk management and hedging. Risk can come from various sources, such as fluctuating prices in commodities or changes in interest rates. Derivatives allow businesses and investors to guard against these uncertainties. Hedging. Companies use derivatives to protect themselves from adverse price movements. For instance, a farmer can lock in a price for their crops in advance. This means they'll avoid losses if market prices drop before harvest. Similarly, airline companies often use fuel hedges to secure fuel prices and manage costs effectively. Portfolio protection. Investors use options to protect their portfolios. By purchasing put options, they can set a minimum selling price for their assets. If the asset's value falls, the option helps offset potential losses. By utilizing derivatives, organizations can stabilize their financial performance, allowing for more predictable planning and budgeting. Speculation and investment opportunities. While risk management is a key function of derivatives markets, speculation is equally prominent. Traders and investors look for profit by anticipating price movements. Short-term gains. Speculators often use derivatives for short-term trades. They might buy call options if they expect a stock to rise or sell futures contracts if they anticipate a drop. These quick trades can yield significant profits, but they also come with higher risks. Leveraging investments. Derivatives allow investors to make large investments with a smaller capital outlay. While this can amplify profits, it can also lead to substantial losses if the trade moves against them. These speculative activities add liquidity to the markets. This liquidity can help ensure that prices reflect current supply and demand. Price discovery. The process of price discovery helps determine the value of an asset based on its future expectations. Derivatives play a key role in this process by providing market signals. Market indicators. Derivative prices often reflect investor sentiment regarding the future value of assets. Traders' collective actions in the derivatives market can indicate expected price movements in the underlying assets. Arbitrage opportunities. If there's a discrepancy between the prices of an underlying asset and its derivatives, traders can exploit these differences. This trading activity helps correct prices and brings them in line with actual market value. In summary, derivatives markets serve essential functions in the financial ecosystem. They help manage risk, create investment opportunities, and facilitate accurate pricing. By understanding these functions, you can appreciate how derivatives impact financial decisions and market stability. Participants in derivatives markets. In derivatives markets, various participants play significant roles. Understanding who these players are helps clarify how the market operates. Each participant contributes to the market's overall function, whether through trading, hedging, or investment. Let's take a closer look at two major groups: institutional and retail investors. Institutional investors. Institutional investors are organizations that manage large sums of money. Think of them as the heavyweights in the financial ring. They include entities such as banks, pension funds, mutual funds, and hedge funds. Their involvement in derivatives markets can lead to considerable impacts due to their buying power. Risk management. Institutions often use derivatives to hedge against potential losses in their investment portfolios. For example, a pension fund might use options to protect its equity investments from market downturns. Liquidity provision. With their significant capital, institutional investors help create liquidity in the market. This means they can quickly buy or sell large amounts of derivatives, making it easier for other participants to trade. Market strategy. Hedge funds, in particular, use derivatives to implement complex trading strategies. They may take on leverage, aiming to increase potential returns by using borrowed funds. Price discovery. The trading practices of institutional investors play a crucial role in price discovery. Their actions often reflect market sentiment, helping to set the price of derivatives. Overall, institutional investors help stabilize the market and contribute to its efficiency. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.